Hi, everyone. Good afternoon or good morning for those from the West Coast. Welcome. And thanks so much for joining us today. I am Rashmi Chanduraj, and I'm thrilled to be your host for today's session on building wealth in real estate, tax strategies that really every investor should know. At Oxstone Capital, we love helping high net worth individuals, like many of you, not only grow like your income, but also be able to tap into some of the amazing tax benefits that are available through real estate. I'm super excited. Like we've got two amazing experts with us today, Amanda Hahn and Matt McFarland from Keystone CPA. Now, if you're familiar with their work, you might have seen them on like Forbes magazine or Money magazine or even on CNBC. I actually first heard Amanda on a Bigger Pockets podcast, like, my God, years ago. So super excited to have them both here. They've actually helped thousands of, investors nationwide reduce taxes and maximize the potential of their, real estate portfolios. They're also authors of tax strategies for savvy real estate investors. So, we've got like some top-notch insights, for you guys today. So let's see what's on the agenda. What we want to be able to get out of today's session is really what are sort of the tax challenges high income earners face and how do you kind of tackle them? Then really look into sort of strategies to reduce taxable income with real estate. Some of the topics that we'll probably get into is like cost seg, reps and 1031. We'll get into the details and really how syndication can be a powerful tool for tax savings. So we've got a lot to cover. Let's get started. All right, Amanda and Matt, welcome. Let's
Thanks for having us, Rashmi. It's great to be here.
Yeah, no, absolutely. Let's sort of jump right in. I know our audience is obviously eager to get into the specifics. Let's start with like the big question, like high income earners, especially those on like W-2 income, like often face like limitations when it comes to deductions. Can you talk about what are some of the primary challenges they face and how do you kind of how do these sort of limitations affect their overall tax situation?
Yeah, I think, it's no secret that the more income you make, the more taxes you pay, right? The tax law works where the more income you make, the higher tax bracket you're in. And so, we also know that for people who only make W-2 income, there are very little tax strategies or tax write-offs against that income. Some of the common ones like 401ks and IRAs, but that's pretty much it. And so when you start transitioning over to the real estate world, the tax law looks at real estate investing as a business. So if you have a job, but you also invest in real estate, now you're a business owner in the eyes of the IRS. And so for a lot of our clients, that's kind of like the first time they start to be able to take advantage of some of the tax benefits of being a business owner in terms of like write-offs and things like that that you typically don't otherwise get to use if you only just have W-2 income.
Yeah, and I think it's also kind of changing that frame of mind, right? People have to, it's W-2, you kind of have to, it's almost like we like to say, like change the fact pattern. So if you're willing to change your fact pattern to some extent, are you willing to invest in real estate? Are you willing to start a business, do something different than just the W-2? Then a lot more opportunities open up for you. But it is going to, takes the person, willing to, change their fact pattern, for lack of a better term.
Yeah, no, that's great insight. Let's sort of change the gear a little bit. Especially, we're in Q4 already, like approaching the end of, 2024. I don't know how the time went, but that's another conversation. What are some of the most like, effective year-end strategies that high income earners can use through real estate investments and especially reduce like their taxable income?
Yeah, I mean, what for all of our clients, and we work with real estate investors nationwide, for the most part, when people come to us, it's because they feel like their current CPA is not helping to bring them tax strategies. I actually met with somebody, we were speaking at a real estate conference just earlier this week, and we met an ophthalmologist who said, "Oh my gosh, my CPA's goal is to make me pay as much taxes as possible."
That's the
Because
goal.
yeah, it's because they don't want, like if I'm audited, they want me to be protected and stuff. And so, when we talk about like how to save taxes, we're always talking about how to do it legally. And really, the only way to save taxes legally is if you do planning, right? Planning ahead of time. And so Q4 is what we consider like the last possible point when you can do planning. Because when you plan ahead on, what are all the things I've done or will do in 2024, then in April of next year, you're able to pay less taxes. If we have the same conversation in January of next year, there are very few things you can do to save taxes for the previous year. So we always recommend, people to meet with their tax advisor before the end of the year on different ways to save on taxes through year-end tax planning.
I mean, specifically, for clients that we're working with who, are active real estate investors. I mean, one of the strategies a lot of them are doing who are W-2 earners, maybe their real estate's not their full-time gig yet, maybe it's like a side hustle. We have a lot of clients kind of using investing in short-term rentals. And a lot of people call it like short-term rental loophole. It's not necessarily a loophole, it's a legal thing, but people who invest in short-term rentals and self-manage them, there are ways through accelerating depreciation that you can kind of create a loss on paper. And if you're self-managing and involved enough, you can use that loss to offset your W-2 income. And so we've got clients using that. Clients who are buying more short-term rentals and putting them in service before year end to kind of get more depreciation on those new properties. So that's the way some of our clients are doing it.
And even I think for some of our clients who are more passive investors, so passive investors in syndications or just passive investors in long-term rentals that they have like a portfolio of long-term rental properties. Year end, we're also looking at, how can we accelerate some of those expenses? So, if I'm expecting to pay taxes on my rental portfolio or on my passive investments, then what are some expenses I could prepay or accelerate? Because if you think about it, if I have some expenses, let's say management fees or marketing fees, if I pay it on January 1st of next year, it's a 2025 tax write-off. But if I pay it on December 31st of this year, now I'm writing it off immediately to reduce my my taxes due next April. So these are the things we look at in fourth quarter, like where are your numbers right now and what are some last minute moves that you can make so you can legally save on taxes for next April.
Right. Like, don't wait till like December 31st, to call you or call, their tax
No,
strategist,
because
right?
we're gonna be on vacation. Yeah.
Yeah.
Yeah, I mean, it's always, I think, fourth quarter is actually the last point in time, or this is kind of like the last ditch effort. Ideally, the best time to plan is actually beginning of the year. So for those of you who aren't used to doing tax planning, now's a great time to start because you're looking at what are some last minute things I can do for this year, but primarily you're looking at what are all the things I can do for 2025. Is it to get more passive investments? Is it to buy a short-term rental? Or is it for me or my spouse to claim real estate professional? When you start early in the year, you kind of have the whole year to really finalize on what you could be doing.
Yeah, no, that's great. I know you talked about just some of the, strategies that are available, with rentals. One big one, or, I've heard is one of the powerful tools is cost segregation. It's come up like several times. Could you break down how it works and what kind of properties are ideal for maximizing those sort of upfront, tax savings?
Yeah, I think in terms of framing cost segregation, it does have to do with depreciation for rental property. So depreciation is probably one of our favorite things to talk about with respect to investing in real estate. We love it because for the real estate investors out there, they all, know you're buying properties. The goal is to get cash flow positive. But this is one of those few asset classes that allows you to write off a part of the purchase price of your asset every year against the income you're making from that asset. You don't get to do it when you buy Google stock, right? You don't write that off until you sell it down the road. But with rental properties, we can take we call it basically a paper write-off against the income every year. And so at a bare minimum, we want enough depreciation to bring our positive income down to zero, so we're not paying tax on our rental income. Now, if we have enough depreciation to create a loss, then we look for ways that we can use that loss to offset our income, short-term rental, real estate, whatever it is. So where the cost seg comes in is it's a way to kind of take more depreciation. Usually on a building, residential rental, you can write it off for 27.5 years. But what a cost seg does is comes in and says, hey, some of that stuff can actually be written off over 5 or 15 years, or maybe even faster through bonus depreciation. So it's a way to kind of take more depreciation up front. And so there's times when we will want to look at doing that where it might be beneficial for a client, but there's times where you wouldn't necessarily want to do it because it does cost extra money to do a cost seg study. And you don't want to pay money if you're not going to be able to get the benefit.
Yeah, and you asked about what kind of real estate would make most sense. It's actually a common misconception that people think cost segregation is only good for large properties like commercial real estate or multifamily or self-storage. But the reality is cost segregation can work on all types of properties. We have clients who are full-time physicians who invest in a couple single family homes where, with just 2 rental properties, you could potentially get $300,000, $400,000, $500,000 of depreciation using cost segregation. And so, especially now where we have bonus depreciation and with technology, you're able to get these studies at much lower price points than, back maybe 5-10 years ago. I would say all kinds of real estate could potentially be great options for cost segregation. But the first step is to meet with your CPA or your tax advisor and really try to figure out, does it make sense for me to do cost segregation? And if so, when should I do it?
Yeah, no, that's great. I love that explanation. I know the other one that, I think Matt touched on was bonus depreciation. What steps should, like investors take, to kind of really make the most of this opportunity, before I know, it is going to be phased out, eventually. Is that this year or next year? Can you talk to us about, yeah.
Sure. Yeah. So bonus depreciation is basically just, in addition to the fact that we can accelerate depreciation, we can take bonus on it, which just means we can write off faster, even faster. So instead of just waiting 5 years, right now we can write off 60% of that immediately. And then the remaining 40%, we can write it off over the next 5 years, as an example. The current law is scheduled for that to go down by 20% per year. So if you buy rental real estate or if you invest in real estate, it's placed in service this year, you get to use 60% bonus. If you do it next year, it's supposed to be 40% bonus. But after elections, our expectation is it could change. Sometimes they might bring back 100% bonus depreciation. We were really close to that happening earlier this year, but ultimately it didn't make the final cut. But yeah, it's just another strategy on how we can accelerate paper write-offs for real estate.
Yeah, and it doesn't bonus depreciation doesn't apply to the entire building of real estate, right? It only applies to certain assets, stuff that's like personal property, maybe land improvements, things that are like 5, 7, 15-year assets. But I think a tip for investors, if you're going out and doing a lot of improvements to a property, what we tell clients, keep a detailed list of all the improvements that you've done. You don't need to be the person that's deciding like, hey, this is a 5-year, this is eligible for bonus, it's not. You just need to be able to give that to your tax person so they can analyze it and say, and do it in the most advantageous way possible. That might be claiming bonus depreciation. It may be not claiming bonus depreciation if it's something that you should spread out over a few years. But without that detailed list, if all you're giving a tax person is I made $100,000 in improvements, there's nothing they can do with that. But if you've got a laundry list of like the various different things you did, there's a lot of opportunities there to maximize your benefits.
Yeah, no, that's great. Now, are these available? I know, one of the things, that I've heard is, it's some of this, tax write-offs are also only available to real estate like professional status, or if you have a real estate professional status, talk to us about, what that means, what's that, sort of eligible criteria, and, especially, could you like just walk us through what it is and how someone might be able to qualify for it?
Yeah, yeah. In the tax world, there are a set of limitations, like you were saying earlier, Ashmi. And effectively, for most investors, if you are not a real estate professional, that means your rental losses are typically considered passive. So if you're someone who makes over $150,000 and you create or you have these rental tax losses, they only offset taxes from other passive income. So that would be like, if I have a rental with a loss, I have another rental with income, they can offset each other, but they don't offset, the loss does not offset taxes from your W-2 income or income from like a medical business that you might be working in. Except if you or your spouse is a real estate professional. This is what we call one of like the best, marriage tax loopholes, because if you are, a high income earning person in tech or in medicine, and your spouse is a real estate professional, well, now your rental losses can offset taxes from all sources of income. And that's kind of the ideal place to be. So, of course, naturally, then the question is, what's a real estate professional? How does someone become one?
See, some people are when they're going out looking for a compatible partner, they're looking for looks, personality. We we
Love.
we say we say you should go out and find somebody who's interested in real estate. That's our marriage advice. But yeah, so qualifying as a real estate professional, again, benefits are if we can create a loss, we can use that loss to offset W-2. There's basically three main rules. All of them are equally as important. Um, and this applies, I guess, taking a step back, this applies if you're investing in long-term rentals. So somebody who's investing in short-term rentals that we talked about earlier, you don't need to be a real estate professional. But for those who are looking, investing in midterm, long-term rentals, the three rules you need to have: spend at least 750 hours a year in real estate activities. Second one, you need to spend more time in real estate than any other jobs you have. So that's where the person who's working full time, this is going to be a big hurdle to me, because if you're working 2,000 hours, going to be hard to spend 2001 hours on real estate. But again, if you have a spouse who's working part-time or not working at all, and they can focus on real estate, you can get past that hurdle. So 750 hours, more time in real estate. And the third one is you have to materially participate in all the activities that you're involved in. So that means for your own rental properties, you need to be kind of what they call like doing the day-to-day operations, involved in a continuous manner, kind of boots on the ground. You could have property managers, but that really muddies the waters a little bit. You really need to be actively involved in managing your own long-term rental properties.
And I mean, from a practical perspective, what we see a lot is we have clients who one person is working full time, as a physician, and if they have a spouse who can be involved in the day-to-days of their rental portfolio, you can see somebody who makes $500,000-$600,000 a year of medical income, and with the right portfolio and the right strategies, pay zero taxes, right? Because as a real estate professional for the spouse, they now can offset all of the income from the medical side. So really phenomenal tax strategy.
Yeah, that's great. I think owning and, obviously it looks like the big takeaway is, obviously you want to strategize, in when and how you purchase these. I know the next big one is, when you're sort of selling your asset, that's like the other time when you're, hit with, having to pay taxes. Obviously, one of the strategies is a 1031 exchange, which is another topic or hot topic, might I say. What are sort of the, steps that investors, can take to kind of navigate, that process? Is that any different, especially now that we're in Q4, is that something that they should plan for, or is there a timing? Talk to us about, what they should be sort of mindful of.
Yeah, I mean, there are, what we typically tell people is, your CPA should be your friend, right? So you shouldn't be afraid to contact them. And in fact, for our clients, we want them to
Just
contact.
not on December 31st.
We want clients to contact us all the time. And the reason for that is before you make a financial move, right? Before that act, there are oftentimes plenty of opportunities to plan ahead to reduce taxes. And so the sale of real estate is a really great example. You know, if somebody already sold a property, now they call me how to reduce their taxes. There could be one or two ways to do so. But if they would have, you know, contacted us like, you know, a month before they listed their property, then maybe there's 15, 20 different options we can consider. But yeah, I mean, for 1031 exchange, this is one of those strategies that have to be implemented prior to the sale of a rental property. So if you're thinking of selling real estate, the first thing is to talk with your tax advisor and figure out what is the gain, right? Calculate the gain, and then calculate the taxes. Because you might be someone with a large gain, but you might pay no taxes if you have other passive losses.
Yeah, and I think it all comes down to the strategy, right? It's, as Amanda mentioned, it's first figuring out kind of, if I do sell it in a normal sale, what is my tax exposure? Is there other things I can utilize to offset that gain so I don't have to go into a 1031? Because 1031 exchanges and other strategies, they involve time, they involve money, you know, there's lots of different things at play, right? Talking about timing, obviously with year end is a great time to think about timing, right? You could be looking at selling a property that could close third, fourth week of December. Maybe it's going to have a lot of gain on it. Now, if you can control that to some extent and push the sale until January 2nd or 3rd without killing the transaction, you've effectively now pushed the entire taxes due back an entire year. And that gives you not only, it gives you a whole nother year to do planning for it too. So there's times like that where the timing can definitely come into play. And as Amanda mentioned, 1031 exchange is one of those transaction or strategies you can utilize. If you've got gain on sale, you're expected to, but it is just one of them.
Yeah, that's really interesting. I know there's a lot more that goes into a 1031, you know, and, you know, yeah, just planning that out, I'm sure is, you know, going to be super useful, whatever time of the year it is, and more importantly at Q4, for sure. Now let's, you know, sort of talk about, you know, syndication specifically. I know, you know, Matt, you talked about sort of just that short-term rental piece, you know, and owning that to offset, you know, some of your taxes. I think that's great. You know, a lot of the investors here also invest in like syndications. I know recently they've become a lot more popular, you know, especially from a passive investment as an option for passive investors. You know, what are sort of some primary tax benefits, you know, that they're able to avail from investing in real estate syndications, you know, and really how can, you know, high income earners sort of use this as an opportunity, you know, especially now, you know, before the end of the year? Is there a better time, you know, through the year, or, you know, especially now in Q4, you know, what is it that they should be looking for?
Yeah, no, we love investing in syndications. A lot of our clients do it. I think there's a misconception out there. I love to hear that your people are doing it a lot, because there is a misconception out there that hey, if I'm just a passive investor in a syndication, I'm not getting any benefits of it. But when we hear that, it's because, you know, that person or their tax person is taking a very kind of tunnel vision approach to it, that yeah, you investing in that syndication may not be saving you taxes on your W-2. But remember, a lot of times when you invest in syndications, you're getting just cash flow distributions quarterly, annually, whatever. And if the syndication is doing things the right way, using their own strategies, a lot of times you're getting that cash flow in your pocket, but not having to pay any tax on it right now because they're doing depreciation, cost segregation, whatever the case may be. So if somebody's receiving $20,000 of distributions and not paying any taxes on it, they've effectively saved taxes, right? Now they're not having reduced the tax on their W-2, but they just got $20,000 of tax-free money in their pocket right now. So I think that's worth mentioning, is that a lot of people don't think of it that way sometimes, and for that reason they don't invest in syndications as much as they might otherwise do it. But yeah, I think from a syndication standpoint, again, if the sponsors are doing their jobs, a lot of times you're not going to be paying any tax on the syndications for the first couple of years. They're doing cost segs, things like that. From another thing to think about, a lot of maybe your clients too, is we have clients who are in the medical field. Maybe they work a W-2, but they've invested passively in a surgery center or a, you know, eye center or something like that, where they're not involved in the day-to-day management of that center, but they're getting a K1 and that's profitable. So they have a K1 with positive income, which is going to be passive to them. So that's a great way to look at the time to look at, hey, maybe I should invest in this passive real estate syndication is going to give me losses for a couple of years. Use those losses to offset the passive income I'm getting from this other K1. Another way to kind of shelter your income that I think people forget about.
We were talking about 1031 exchange earlier. We have clients who maybe they want to sell their portfolio of rental properties, but they don't really want to exchange up into more real estate.
Or they don't want the stress of it, right? Like,
yeah, where it turns
Yeah.
into like a full-time job for them. And so one way or one strategy is what we call the lazy 1031 exchange, which is where you sell a rental property and you reinvest your money into other syndication deals. As long as it's done within that same year, if the syndication is kicking off tax losses, you could use the loss to generally offset the gain on the property that you sold as well.
Yeah, no, that's a great point. Yeah. Now, how common is, especially investing in like opportunity zones, is that, does that offer any, great sort of tax benefits?
Yeah, I mean, what we love about opportunity zones is it's not just limited to real estate. In a 1031 exchange, we're only talking about when you sell rental property, you can reinvest in rental property. Opportunity zones are really great for a lot of our clients, like in the tech space, or even just business owners who are selling a business, because Ozone allows you to reinvest any kind of capital gains into these opportunity zone funds. And when you do so and you follow all the rules, then you can defer the capital gains taxes until 2026. So we do really like that. But I think practically speaking, we see that most frequently when people sell businesses or stocks. For our clients, when they sell real estate, they generally tend to still favor 1031 exchange. It's a little bit more straightforward.
Yeah, I think on the opportunity zone, it came out in 2017, 2018. And at least based on our practice, I don't think it's been used as much as probably the government thought it was going to be when they came out with it. There is the one benefit that if you sell, you've got a capital gains event and you can defer the capital gains tax until 2026. That's one carrot that they dangle. The other huge benefit that they talk about is when you're reinvesting into the opportunity zone, if you hold that opportunity zone asset for at least 10 years, the appreciation you can get on that can become totally tax-free. So in the right scenario, if it's an asset that's gonna, the appreciation is gonna be there, it's something that you expect to hold on to for 10 years, then the numbers can pan out. But if it's something that you're gonna sell in 3 years and move on to another asset, it probably won't pencil out in that scenario.
That makes sense. I know both of you are, real estate investors as well. What are some of the strategies that we've not talked about that would be beneficial for our audience to, hear about? I don't know, maybe leverage.
Yeah, I mean, tax law, I think it's no secret tax law favors real estate. And what I think people often don't think about is tax law also favors leverage. When we talk about depreciation, it's not based on your down payment. It's actually based on the purchase price of your property, right? So if you have $300,000 of cash, you can either buy a property all cash for $300,000 and get some depreciation, or you can use that $300,000 to buy $1 million worth of real estate. And your depreciation starts at $1 million for calculation purposes. So especially for people who are high income earners or you have a profitable business, to the extent you're comfortable in using leverage, you can oftentimes go further when it comes to real estate and tax benefits, right? Because what better way to grow your wealth than to use other people's money to not just generate more cash flow, more equity, but also generate more tax savings too.
And especially if you're somebody that, I don't know, maybe you're not going to go into real estate full time. Maybe you have a job or you run a medical business that you love what you do. Why would you stop doing that, right? Well, that's where investing in syndications and other people's deals, you want to put your money to work for you, right? It would be, I mean, almost be negligent not to do something with your money for 20 years and just keep working, pounding away your job. And, sometimes retirement accounts are not enough, right? And so why not put your money to work for you and use other people's expertise to make your money work?
Yeah, and speaking of retirement account, I mean, for a lot of our clients, I just think a lot of Americans in general, right? Oftentimes retirement accounts are our biggest source of net worth because, you know, if you have a job, you're just putting money away. Sorry, Matt and I have a cold. In case you can't tell, we keep
Yeah.
coughing. We just came
That's
back from
okay.
speaking at an event, so like our voice is all gone from speaking.
Oh my God. Yeah.
Yeah. So what we find is that for a lot of our clients, a good chunk of their wealth is actually in retirement accounts like 401ks, IRAs, pension plans. Oftentimes, it makes sense to think about whether the retirement money would be better used in other asset classes such as real estate. Because I think people tend to think, well, my 401k has to be in the stock market, stocks, bonds, mutual funds, is the annuities, right? But the reality is the IRS allows us to use retirement money for all kinds of real estate. You could roll your 401k money to an IRA or a self-directed IRA and use it to buy a property on Main Street or invest in a syndication or make note investments. There's so many different possibilities. And when you're looking to build wealth, it's important to look at everything you have and put everything to work for you in the optimal way, right? Some of these are we call lazy assets, where it's just like people don't even know what the retirement account is doing. They don't know that it's not been performing for the last 15, 20 years, you know, and it's like, well, let's change that. Let's put it to work for you.
Yeah, no, 100%. I'm totally, guilty for that. Been in corporate for like 20 plus years and, just had it sitting there with that, it's only much later did I realize, oh, well, I can actually go and, invest it into something else. So 100%. Yeah, I know we've touched on, some really great strategies. I'm also just curious, especially for, as a multifamily like investor, what do you think are, usually sort of common mistakes that you guys have seen? What are pitfalls that one can avoid, to one, obviously maximize their, like returns and protect their investments?
I think I'll speak on like on the syndication side. We oftentimes
Yeah.
have clients who are new to syndication investments. So they'll invest passively in a deal and then they'll call us and say, oh, I need you to recalculate my quarterly taxes because I just got a distribution check from this apartment investment. So I want to make sure I pay taxes on it. And the reality is when you're investing in a syndication, especially things like multifamily, more likely than not, even though you're getting distributions of cash, you're probably not having to pay taxes on that immediately. And the reason for that is because at the syndication level, they're probably using a lot of these strategies we talked about, like accelerated depreciation and bonus depreciation. And so instead of just assuming you have to pay taxes on the distributions, you can talk to the sponsor and say, hey, I got this. Am I expected to pay taxes or is the K1 expected to be a loss? Because we don't want investors to overpay in taxes for no reason, because you're just making an interest-free loan to the IRS.
The thing that comes to my mind is probably one of the biggest mistakes we see for people who have their own portfolio. Maybe they start investing in multifamily. They're kind of growing, buying a little bit bigger properties. But all along in that spectrum, the one biggest mistake people make is they overlook a lot of deductible expenses related to being a real estate investor. So most real estate investors are good about capturing mortgage interest, property taxes, insurance, the stuff that's tied to the property, right? But it's those kind of what we call like those overhead costs of being an investor. So you're going to conferences, you're going business meals, you're going taking people out to lunch to talk about business. You've got dues, you've got mileage, right? Your vehicle, you're driving to go to look at different properties. Home office expense, another big one. So a lot of these overhead costs that people overlook, I don't know, they don't know about it. They don't know what's deductible. They aren't keeping good records or good financial statements. They're trying to create it a year later for last year, because of course that never happens, right? But so I think that's one of the biggest ones that we see can add thousands to tens of thousands of dollars of deductions on everybody's return, that it's going to either help you now or help you in the future. Why wouldn't you take it?
Yeah, no, that's great. When is actually, when is it a right time for investors to enter, like and invest in multifamily specifically? I mean, because to your point, there is just so many places that they're able to, invest in, whether it's short-term, it's multifamily, it's, just owning long-term rentals. I just want to understand, like, when is it a good time to, say, okay, well, now I think I need to, expand or diversify and, expand my, real estate portfolio.
Mhm. That's a great question. I think the answer is going to differ for every investor. Um, when we do tax planning with clients all over the US, part of the decision process is what I should invest in, So if you are a single person with high income, or if you're married but two working professionals, we often start with short-term rentals. Like if you do a short-term rental, then you get all the tax savings. It doesn't mean that the property always has to stay as a short-term rental. We also have clients who do multifamily, but they are used as short-term rentals. So all 15 units are short-term rentals, right? And so it really depends on what the profile is, purely speaking from a tax perspective. But I also think what you should invest in changes depending on what season of life you're in. So like when we first started out, when we had limited cash, when we had more time, we were able to be more hands-on and more active, house hacking or, buying properties that we were more involved in. And now that we have, young kids and we're growing our business, we are pivoting more towards syndication investments, multifamily, commercial real estate as passive investors, because I feel like in this season of life, we have more resources, but less time. And so like Matt said, we want to leverage other people's time and expertise. And I think that might change again once our kids are older, then we might go back into the more active, right? So I don't think there's a right like time frame. It's more just going to be specific to your financial profile and like where your resources are.
I could give a great example is pretty typical scenario in our client base is maybe somebody's invested in single family houses for a few years. They built up that kind of portfolio. Maybe they got 5 to 10 properties. They've been working the W-2 job. We've talked about real estate professional. It wasn't something that was available to them early on, but it was something like a 5-year plan. So transition to year 4 or 5.
Yeah.
Okay, well, I've got a good number of single family houses, but those are kind of almost sometimes set it and forget it, right? I've got my long-term tenant that doesn't require a lot of time, but I want to get to the real estate professional. So I need to get my 750 hours. That could be a year where someone's transitioning to multifamily because by nature, obviously multifamily is going to theoretically involve more things to be done on the property, right? So maybe you buy an small 8-unit property that you are going to kind of self-manage and you can get your real estate professional time. Maybe your spouse is still working and it kind of works all together at that point in time.
Yeah. That is great. Those are definitely good, strategies. And, it's so true. I think it is so sort of dependent on where they are in their journey and, at what point they are in their career. So that's a good point. I'm curious actually when, especially when, and I've gotten this question a couple of times, from investors, especially when, they're wanting to invest in like a syndication as a passive investor. I think how are, like their question is, hey, should I be investing as an individual? Should I go in and invest as an LLC? And that's come up often enough. So I'm just curious, should investors actually consider investing through an LLC or as an individual? I mean, what are the benefits or, drawbacks that, like each approach has?
Yeah, I think that a couple takeaways here for people is, well, if you're going to invest in syndications that have, appreciating real estate, they're investing in rental properties, things like that, you do not want to use a C Corp or an S Corp to invest in those syndications. So if you have somebody that's got an S Corp for like an active business or something, you do not want to have your investor in the syndication be your S Corp. So outside of that, you could use your personal name. You could use like a single member LLC, like a disregarded entity that you're the 100% owner of. Maybe it's a partnership between you and your spouse. Generally, in any 3 of those scenarios, from a tax perspective, there's no difference whether you invest in your personal name or use that LLC in that example. It's probably more of an asset protection play. So depending on the person's net worth, kind of their what they do for a living, what their exposure is to liability on a day-to-day basis, if they met with their asset protection attorney, they may say, yeah, you investing in that syndication, that is an LLC. It does provide some layer of asset protection, but they might want you to put another LLC in there with your own to invest in that as another layer. But again, from a tax perspective, not much difference at all.
That's good to know. So there's really no, especially since you talked about liability protection, there's really no sort of advantage, in that scenario, in going via an LLC versus an individual. You're still able to, kind of take advantage of those tax benefits.
Yeah, for
It's
sure, for sure.
awesome.
Yeah.
Yeah.
And I think for most passive investors, I mean, we're not attorneys, but I feel like for most passive investors, they're not really on the hook for a lot of, risks associated, right? It's usually at the fund level
An
or the
investment.
sponsors are. And when we talk about legal entities, we always also want to look at the cost benefit. If you form an entity to invest in someone else's deal and you're in California, then you have to pay additional fees to the state just to have that entity every year. And so those are the things you want to talk to your tax advisor about. Does it have to file a separate tax return? What are all the costs associated with that?
Yeah. So would it make sense for, investors who invest in multiple deals at that point to invest in, like use that LLC and use all of their investments under that one LLC?
I mean, possibly. I think it just depends on the risk tolerance, how much equity you're talking about, right, with respect to the assets held in the entities.
Yeah, that makes sense. I'm also curious, and again, this is, a question that has come up, with some of the investors, especially investing, in multifamily syndication. Like, for example, if they invest like 100,000, like the belief or, at least their perception was, oh, well, I can get bonus depreciation and it's 100%, when it was a few years ago. So that means we can potentially walk away with, like 100% of whatever we invested in as a write-off. Can you can you talk about that a little bit? I know we touched on bonus depreciation earlier, but I'm curious if you can kind of walk us through specifically what could be those expected returns, and maybe in an example that might be better for the audience to sort of understand. Hey, if I invest 100,000, this is potentially what that passive investment, impact
Yeah.
can have.
I think a couple of years ago when bonus depreciation was at 100%, it wasn't uncommon for our clients to get K1s. To your example, they invested $100,000 and the K1 and their share of the company's loss in that first year might be $80,000-$90,000, because again, that syndication is using leverage to go out and buy real estate, generate bigger losses on paper than what people had invested.
Yeah.
Nowadays, you're probably looking more at, if you're investing $100,000 in the same scenario, they're probably getting a K1 with maybe $50,000-$60,000 loss in the first year. Now, at the end of the day, then the next question is how and when are we using that loss, right? So you've got a K1 with a loss. Is it passive? Is it active? Are you a real estate professional or not? Even if you can't use that loss right now, it does carry forward and you can use it again in the future to offset passive income in that example, right? So but specifically your question, yeah, that's kind of the difference we're seeing, a couple years ago versus now.
Yeah, and I think too, it varies highly depending on each deal. So if you're investing in a multifamily in New York, depreciation may be a lot less than if you're investing in multifamily in Ohio, right? And the reasons for that is because land is not depreciable. So if we have an apartment building in New York where land is 80% of your purchase price versus in Ohio where land is 10% of your purchase price, then there's a huge difference in what that first year K1 loss is going to be. Also, we have seen a lot of, our syndication clients have more reserves. So whereas a couple years ago, maybe if they raised $1 million, they go out and buy $5 million worth of real estate. Well, now maybe if they raise $1 million, only buying $3 million worth of real estate, right? And they want to keep more of the reserves to pay for unexpected things. So I think as a passive investor, how do you know? Well, ask the sponsor, right? Ask the sponsor, ask the managers of the syndications. They should be able to give you a range on, okay, if you invest this much with me, this is kind of a ballpark range of how much you can expect, because it does differ from deal to deal. And even with that same syndication, it might be different. If you have two funds, so one in New York, one in Ohio, there might be very different depreciation benefits.
Yeah. So it's not so much dependent on, the investor as much as, the investment that they're actually
For
involved
sure,
in.
for sure.
Yeah.
Yeah, I mean, there's a lot of different things that, that go into kind of the calculation of what people get. So I definitely wouldn't have people just expect if I did 100,000, then it's $100,000 write-off.
Yeah. No, 100%. Yeah. Awesome. I know we've covered a lot already. I want to make sure that, if the audience have any questions, that we could get a little deeper, perhaps, with some of the questions that they have. So I just want to call out to the audience. I mean, if you guys have questions, you can either just raise your hand or, put your questions in the chat. And we'll get to as many as we can. I know we have a little less than 15 minutes to go.
We can take Daniel's question. What are some of the tax implications an investor should keep in mind when converting a long-term rental to a short-term rental?
I mean, a couple things that come to mind is, depending on what, figuring out what your strategy is, right? Is if you're somebody that is investing a lot of long-term rentals, you already qualify as a real estate professional, and then you're going to convert a property to a short-term rental. Well, if you're expecting to want to be able to use losses from that rental against your income like you have, then in addition to being real estate professional for your existing stuff, you also have to meet the rules for short-term rental because those are two different buckets. But if you're somebody that's a long-term rental investor and not a real estate professional because you work W-2, then yeah, converting a property from a long-term to a short-term could be a good play because if you can self-manage it and create losses on that one, now we can use those losses to offset our W-2 income. Another thing to just keep in mind, just so you know, and this is something that's done on a tax return, but long-term rentals depreciate over 27.5 years. Short-term rentals depreciate over 39 years. So there's a slight difference there, but again, that's something that happens on the tax return, but that's something to kind of be aware of.
Oh, that is great. There's, another question here. How can we report our multifamily rentals on a FAFSA for the upcoming college freshmen?
I've not done a FAFSA for our kids, and it's been a million years since I did one.
It's been a while since I looked at one, yeah.
So I don't really know the answer to that. But I would definitely ask your financial advisor. They're typically the ones that help you fill out the FAFSA forms. I mean, my understanding is all those numbers come from your tax return. So if your rentals are showing up as, income or losses on your returns, I imagine that's what they'll be reported. But I don't know. We don't really help people with college applications. But yeah, usually your financial advisor will be the one to do that.
Yeah, that's great. Any other questions? Yeah.
For those of you who, if some of the stuff we talked about is new to you, if this is the first time you're hearing about real estate professional or the short-term rental tax loophole, you can go to our website, KeystoneCPA.com. We have some really great free downloadable resources that kind of gives you the details on what those terms actually mean. Or if you have questions like what legal entity should I use, how do I pay my kids and get a tax write-off, we have a lot of great information there as well. I know today we kind of hopped around and talked about a lot of different things. It's hard to gauge everyone's experience level, but that's a good foundation, like a starting point of some of these things you're like, what are you talking about?
Yeah. Daniel has another question here. Can you talk about strategies for overseas investors to invest in syndications?
So we don't really handle foreign taxes, meaning if you're in Canada, obviously talk to your Canadian CPA about the tax impact of investing in the US. But for US purposes, I mean, I think we treat foreign investors just the same. Generally you're going to get a K-1. What I typically see is foreign investors will form a US entity, like a US LLC or something, to then invest in US real estate. I'm not sure if that's because typically your home country is better served that way or not, but that's how we typically see it.
Yeah, well, so one reason for that is for the benefit of the actual syndicator. So if you're somebody that's putting together a syndication, you're going out and raising money from investors, and maybe some of those investors are going to be foreign individuals. Not saying you don't want to take their money, obviously, because you want to, build your investment. But the reason they do that is because you'll have the foreign investor create a U.S. entity to invest in your syndication on your end. That alleviates you of the requirement to withhold U.S. taxes when you send distributions to a foreign investor, because your investor is now a U.S. entity. Now, then it turns to the requirement gets pushed onto them, because now they have their U.S. entity putting money to them. That's their requirement, not your concern anymore. So it alleviates some of the administrative hassle of for the syndicator. So definitely a good thing to look into if you're putting together your own deals.
Yeah, no, 100%. I know it's, like international like taxation piece can get complicated. So, for sure from a, syndication side, we obviously, want to deal with an entity that's, within the US. It's just easier as a syndicator to manage. So, yeah, no, 100%. And I think, there's also regulation around where the money is coming from. So, when it's a US entity, it's just easier, I think, to manage some of that. But yeah. Awesome. Well,
we actually have a tool. Do you mind if I share my screen, Rashmi?
Yeah, absolutely. Do you have the rights
Let me
to
see
do
if I can
that?
get it to work.
You should be able to, right? Yeah.
Do you see that?
Yeah.
Okay. The question we get all the time from people is, how do I know if I'm overpaying in taxes? Like I hear these strategies, but how do I know if I'm actually overpaying or if I'm doing okay? And so Matt and I put together a tax risk assessment. It's a series of questions that you answer yourself, and you get a score at the end of it to see what your risk level is currently in overpaying in taxes. And the good news is that if you score low, and your risk is high, you can just print that off. And next time you meet with your tax person to do planning, you can use that as a starting point to talk to them about, hey, here are the areas that I said no to. Can we talk about whether some of these are great opportunities for me to start saving on taxes? So
Yeah. That's
Yeah,
an
and
awesome tool.
if the person, but on the flip side, if like that, you take it to your tax person and they like have this glazed over look, they don't even understand the questions that are being posed on the page, that's probably a good sign you've outgrown your tax person, or they're not well versed in real estate, and be something to look at, upgrading your team, obviously.
I know we have like some medical professionals, right, on this webinar with us. I always equate tax planning to going to see a doctor. Like oftentimes people go to see their CPA and then they have a bunch of questions like, tell me about cost seg, tell me about real estate professional, tell me about short-term rental. And then what they tell you is, no, you can't do this, can't do this, can't do this. But when you do true tax planning, your CPA should be the one asking you the questions. And from those questions is how they can give you strategies. Like, what are you doing? Where are you investing? Who are your partners? How much is in your 401k? Then they help you build a solution. Just like when you go to the doctor, you're not asking your doctor a bunch of stuff, or you shouldn't be, at least, right?
I mean, Dr. Hahn is, but yes.
Your doctor should be asking you a
Yeah.
bunch of questions so they can help diagnose the problem and create a treatment. So keep an eye out for that next time you meet with your tax person to see, am I involved in like a Q&A, or is this really some strategy session that they're asking me really great questions?
Yeah. Yeah, no, absolutely. I think, just part of that discovery, where they're able to understand and see what, tax, I don't want to say loopholes, but, strategies are available that, they're able to leverage. Yeah, 100%. That's great. I'm going to have to check that, tool myself, but, thanks for, thanks for sharing that. Well, Amanda and Matt, my God, thank you both so much for sharing, your guys' knowledge. The insights today was awesome. It's really been, fantastic. I know we walked away with just so many valuable sort of strategies that you guys sort of touched on, right from, like cost seg, short-term rentals, we talked about opportunity zones and, just so many other like areas that, folks can actually, go back and, dig deeper and ask those questions and, and strategize and, plan better. I think that's the key, to be able to plan and, not be in a situation where, yeah, like you're deciding end of the year, when you really don't have
Mhm.
any room to, to make any changes or to really build a strategy. So
Yeah.
that was really, really powerful. And I'm sure, like for our audience, they've got a lot of things to take away, from this. So thank you, for joining us today. We really hope that, the audience got to take away all of the valuable insights, and, we can't wait, for you guys to, maybe do another future event at some point. But thanks again for, joining us today, and, for the audience as well for being here, and have like an amazing day.
Thanks, Rashmi.
Yeah, thanks, Rashmi. Thanks for having us. That was fun.
Yeah, thanks so much.